It's no news that college costs are skyrocketing and that saving for college can be a challenge. Taxes can put a dent into any interest or other investment income in a conventional college savings fund. But there's a special savings plan that can protect those earnings from taxation. I'm the Tax Geek, and here are qualified tuition programs, most commonly known as 529 plans, oversimplified. This viewer comment inspires this video. If you'd like to see your suggestion turned into a video or have any additional questions or comments, please leave them in the comment space below. 529 plans come in two types: college savings plans that are sponsored by states, and prepaid tuition plans, which are offered by the educational institutions themselves. College savings plans work very much like Roth IRAs. There is no immediate federal tax benefit for contributing, but the accumulated earnings, when withdrawn and used for qualifying educational expenses, are free from federal or state tax. Prepaid tuition plans, which are offered by both state and private colleges and universities, work similarly to a college savings plan for tax purposes, but allow the owner of the plan to lock in today's tuition rates for future attendance at that specific institution or state university system. Should the beneficiary decide not to attend the institution, the funds in the plan can be withdrawn and used for eligible expenses at another school, though not with the guaranteed tuition. Although contributions to either type of account are not deductible for federal income tax purposes, most states allow for a full or limited tax deduction for the contributions, and others offer tax credits for doing so. A list of these states is currently on the screen. The rules about the deductions or credits can vary widely by state, so check with your state's 529 plan website for details on any requirements or limitations. There are two parties to a 529 plan: the owner and the beneficiary. The owner is a person, usually a parent, but it doesn't have to be, who establishes and controls the account, and the beneficiary is the person for whom the account was established. There can only be one beneficiary on an account. If a person wishes to save for multiple children, a separate 529 account must be established for each one. The owner of the account directs how the contributions are invested. Much like an employer 401k plan, the various 529 plans offer a wide variety of investment options with varying degrees of risk. Most also offer target plans, where the owner selects a plan using the year the beneficiary is expected to enter college. These plans automatically adjust the risk, selecting higher risk investments when the beneficiary is younger and decreasing the risk as the beneficiary nears college age. Anyone, not just the owner, can contribute to the plan, including grandparents, other relatives, or even friends of the family. One of the nice things about 529 plans is that there are no limits on either annual or lifetime contributions, except that they can't be more than what is reasonably necessary to pay the qualifying expenses. There are also no AGI limitations on the owner or any contributor to the plan. As long as the funds in the plan are used for qualifying educational expenses, any distributions are tax-free. However, if they are not used for qualifying educational expenses, the earnings in the plan are subject to federal and state income tax and a potential 10% penalty for the non-qualifying distribution. So what are considered qualifying educational expenses? Quite a bit, actually. They include tuition, fees, books, and equipment required for enrollment at the school, room and board, subject to limitations, and computer equipment, software, and internet access used primarily for academic purposes. In addition, up to $10,000 in distributions can be used to pay off qualified student loans for the beneficiary or a beneficiary's sibling. And finally, up to $10,000 in distributions can be used for private elementary and secondary school expenses. When there is a distribution from any type of 529 account, either the owner or the beneficiary will receive a Form 1099-Q, depending on who actually receives the funds. If the funds are paid directly to the beneficiary's school, college, or university, the 1099-Q will be issued in the beneficiary's name. On the form, let's take a closer look at boxes 1, 2, and 3. Box 1 shows the total distribution, and boxes 2 and 3 separate the distribution into earnings and basis. The basis is essentially what was contributed to the plan, and the earnings are what those contributions earned in interest or other investment income. Knowing the amount of earnings is important for a number of reasons. First, if the distribution is non-qualifying, the earnings are what is potentially taxable and subject to a 10% penalty. Next, the earnings must be subtracted from any qualifying educational expenses that are used to claim either an American Opportunity Credit or a Lifetime Learning Credit. To see how this works, let's go back to the American Opportunity Credit video and revisit Robert, Laura, and their son Richard. Robert and Laura have $5,000 in expenses to pay for Richard's first year in college. If Robert and Laura had paid the $5,000 out of their own funds or borrowed the money, they would have $4,000 in eligible expenses with which to claim an American Opportunity Credit of up to $2,500. But instead, Robert withdrew $5,000 from Richard's 529 plan that Robert established when Richard was a baby. Of the $5,000 distribution, $2,000 was basis and $3,000 earnings. If Robert and Laura paid the $5,000 in expenses using the distribution, the $4,000 in expenses eligible to claim the American Opportunity Credit would have to be reduced by the $3,000 in earnings from the 529 account distribution, leaving only $1,000 in eligible expenses, resulting in a credit of only $1,000. So careful planning is required when considering 529 plan withdrawals to get the maximum benefit from both the plan distribution and any available education credits. If you're unsure, a qualified tax professional can be of great assistance with these matters. This also comes into play when using 529 plan funds to pay off student loans. The distribution might affect any student loan interest deduction. So now the question is, what happens if the beneficiary decides not to attend college, or there are funds left in the account after the beneficiary graduates? The good news is that there is no age limitation after which the funds must be distributed. So if the beneficiary decides to go to school later in life, the 529 funds are still available. Prior to 2024, the only thing that could be done to avoid taxation when unused 529 funds were distributed was to name another relative as beneficiary to the account. In this case, the IRS is pretty liberal when it comes to defining a relative. Just about all the relatives that you can use to claim a dependent qualify, in addition to first cousins. However, starting in 2024, under the Secure 2.0 Act, an unused balance in a 529 account can be rolled over into a Roth IRA for the beneficiary. As long as the beneficiary reaches age 59.5 and has held onto the Roth IRA for at least 5 years, any distributions, including earnings, are non-taxable. If you'd like more details on 529 plans, additional information and resources are linked in the video description. Please like the video if you found it informative and share it with anyone who could find it useful. Subscribe to the channel to see more oversimplifications of our overcomplicated tax system. As always, thanks for watching, and I'll be back soon with more of your taxes oversimplified.